Okay, I'm looking at modified audit reports and past exam questions. And I'm concentrating really on the modified audit reports where there's an issue with the financial statements. And we were looking at some past questions, and in the last screencast we looked at Spirit as an example. So I said you should read down through the questions. And from reading the scenario, you should be able to highlight the issue, and then you're going to go back and talk about it in more detail. But we've read the first two there. Spirit, we read it. We see that they've valued inventory incorrectly. They should have valued it at the lower of cost or net realizable value. So we know there's an error in the financial statements. Inventory is valued incorrectly. So we've got an error. And there's the issue that you need to discuss. We determined that the issue is material, or the error is material and pervasive. It's pervasive because if we write down the inventory of 400,000 to nil of these USB sticks, that's going to turn the profit into a loss. So that's going to change the nature of the accounts, make the accounts as a whole unreliable or misleading. So it's a pervasive error. And then that means then the auditor will give an adverse opinion in the report. So it's an adverse opinion or adverse report. So really, those couple of words, you hang your answer on them. And here is it written out. Explain the issue, determine materiality, say adverse opinion, and then show that you know what an adverse opinion is, which is, in our opinion, the accounts are not true and fair. And that's the answer to that. The next scenario on this is Xantia. You take a read of it, then you determine what the issue is. So we've taken a read of it, and we can see that there is a lack of evidence unable to obtain direct confirmation from the airline companies in relation to the existence of the assets, and other procedures have been unsuccessful, and the company won't pay our cost to fly out to Africa and attend the location. So you've got a lack of evidence, which is a limitation of scope. Then you look at materiality. So the value of the leased assets about which there's a lack of evidence is 4 million. As a percentage of profit before tax, it's 18%, so it's material. It's a material limitation of scope. So if a limitation of scope is material, you're looking at a qualified opinion, where you say financial statements are true and fair except for possible errors in leased assets about which. So I've kind of written that here. Qualified opinion except for possible errors. And it's important to say possible errors when it's limitation of scope, because that's what it is. It's not an actual error. So you hang your answer around these kind of points and explain each of them in more detail. If it was an error in the financial statements, we'd be explaining the accounting issue, but you're never explaining the accounting issue, because there is no accounting issue. There's no mistake. There's no accounting standard that was interpreted incorrectly. So you want to talk a bit then to get the marks, a bit about the alternative procedures. So something like that there in the middle. Not vital, but it'll just get you that extra half mark to make the answer full marks. Then materiality is here. So 18%, and then it's not pervasive because it wouldn't render the financial statements as a whole misleading. So you've got a modified limitation of scope, a material limitation of scope, therefore you've got qualified opinion, and then show that you know what that means. In our opinion, accounts are true and fair except for non-current assets about which we are unable to form an opinion. Or about which there may be possible errors. It's I suppose, unable to form an opinion. So what you're saying there, the accounts are true and fair except for this this area non-current assets. And I've got a note there, but that's just for you watching this, if the limitation of scope was pervasive. So if instead of 4 million it was 100 million, then it would be pervasive and you'd be looking at a disclaimer of opinion. But that's not relevant to this scenario. Here's another question. In respect of the three situations outlined above, discuss whether or not the audit report should be modified, giving reasons for your conclusion. So if we look at the first one, green, as I said, read down through them, what's the issue, so you spot fairly quickly if it's an error or limitation of scope, or if the accounts are correct and you're looking at unmodified. It's been sued by a group of contractors. It's in, okay, the year end is December, so you're talking April 16. Should they provide for this is the question. It's probable. So the solicitors have informed you it's probable that the court will find in favour, so it will have to pay out, and that the amount is going to be approximately 2 million. And then the directors have disclosed a contingent liability of 2 million in the notes. So a contingent liability is just a disclosure, it's not an actual liability. So here we are, error instead of der, and the error is about a provision versus a contingent liability. So they should have recorded a provision or a current liability. So in your answer you need to explain the rules. Then it's pervasive because if they provide for this, they'll credit current liabilities 2 million and debit increase in provision in expenses, which will turn the profit of 1.5 million into a loss of 0.5. So that's a pervasive error. Else if you just got 2 over 1.5, it's 100 and something %. And we said if it was greater than 40%, it's pervasive. So then you've got an adverse opinion. We've got an error. It's pervasive, adverse opinion, and then state that in your answer. So profit is overstated by 2 million, liability is understated by 2 million. And error in the financial statement, so you're clear about what it is. Here we've got the answer. So talk about the 3 criteria for recording provision. And we've got each of these: obligating, past event, probable, and the amount can be reliably estimated. So solicitors. So then you say a provision should have been recognised, and then it was incorrect to disclose, just disclose a note. Then we look at pervasiveness or materiality, which is pervasive, large enough on its own to render the financial statements misleading. So you've got a pervasive error, so that means it's going to be modified audit opinion and adverse opinion. And then you show that you know what an adverse opinion is. In our opinion, financial statements are not true and fair. Moving on to red. Okay, credit 100% of the grants to the income statement as other income. Okay, doesn't look like they should have done that. Do you know the rules? Generally what happens is the grant should be recorded debit bank and credit deferred income, because you've got this income, and the income should be then, which is the current liability, in the balance sheet, and the income then, the deferred income, is written off to the income statement as income over the life of the asset. The other way of doing it is to reduce the cost of the asset, but it's better to show it as deferred income. Really, it's more appropriate. So we've read red, and we see they've made a mistake in recording revenue. They've credited the grants up front to income 100%, when really they should only have credited 10% to other income. 90% of the grant should have been deferred to liabilities, as the equipment has a useful life of 10 years, so only 1/10 can be shown as income each year for 10 years. So then you'll explain the rules for recording. You say it's an error, you'll explain why. You talk about deferred income, revenue recognition, what they should have done, calculate materiality, and 0.9. So revenue should only have been credited, or other income should only have been credited with 0.1, 1/10 of 1 million. So it was 0.9 million overstated. So the error is 0.9 over the profit of 10, so it's 9%. So we've an error that's material. Therefore, it's qualified except for. So an error in the accounts, in the financial statements, it's material. Qualified opinion, financial statements are true and fair except for error in. And you hang your answer around that and you explain all those areas. So at the start, it's good to say there was an error, say why, and then say what's the problem. This is me explaining the accounting rules. Where there has been an error, there'll always have been an accounting mistake that you need to explain. So they should have debited bank, credited liabilities, and then taken 1/10 out of that each year and putting it into other income. And then we talk about materiality. So profit to go down by 0.9 is 9%. And it's not pervasive. And it's good to say not pervasive, not large enough to render the financial statements unreliable. So material error, modified audit opinion, and qualified. And then you show that you know what the qualified opinion is. Once again, here's blue. Take a read. So the year end was December 15, just that's important. And in February 16, there was an event, a recall of toys, and they were sold below cost. The event happened after the year end, so also you'd be explaining that it was a post-balance sheet event or a subsequent event, and then you have to explain it was an adjusting event. So inventory should be written down to the lower of cost and net realizable value. It's adjusting because any further information on inventory about its value is adjusting. It's material. It doesn't give us the amount, but it says that inventory is a material amount of the financial statements, and this was 25% of all inventory in hand. So it doesn't give us enough to say for sure if it's material or pervasive or immaterial, but definitely you could go with material because it says inventory is a material amount and we're talking about a quarter of that. So it's unlikely to be pervasive because it's not big enough if it's only a quarter, and inventory by itself is material. So you've got a material error, so therefore qualified audit report, which means the accounts are true and fair except for errors in the valuation of inventory and profit also overstated. So the recall of good happens after year end, so it's subsequent or post balance sheet event. Show that you know what a subsequent event, an adjusting event is. It reflects conditions existing at year end that only crystallize after the year end. Financial statements should be changed to reflect the adjusting. That's the big thing. So once you establish it's an adjusting event, then you say the financial statements should be changed, and then the sale of inventory after year end giving evidence of its net realizable value is an adjusting event. So it needs to be written down. We can't determine for sure what it is, but it's unlikely to be pervasive, material and pervasive. We can shorten that to pervasive. So it's probably not large enough to make the financial statements as a whole unreliable. So you've covered yourself there with the pervasiveness by saying, you know, it's not large enough to be pervasive. It's not large enough to make the financial statements unreliable. And then once again, you cover yourself more. If it was pervasive or is pervasive, the auditor will issue an adverse report. So you're covering yourself there, but you are coming up with a decision which is that it's material. That's your decision. But because it's a bit vague, you're just covering yourself by talking about the pervasiveness. So material error, a modified report, and it'll be qualified and show that you know what that means. In our opinion, financial statements are true and fair except for the errors in inventory. Here's another question. So the year end is December 14. There's the pre-tax profit, tells us that, so we can calculate materiality. And I'm looking at number A. So we have inventories of 2.5 million, of which 275,000. So here there's a lack of evidence. The audit senior could not verify the value of the contract at year end. And it's not the audit senior's fault, it's because there was no backup. So you've got a lack of evidence, which is a limitation of scope. We want to mention other procedures in the answer because just to get the marks. It's material because it's 22% of PBT, so 275,000. Divided into 1250, it's 22%. There's the 1.250. So we have material limitation of scope, so it's qualified and it's except for possible errors. So once again, you're back here, limitation of scope, qualified when it's material. Financial statements are true and fair except for possible errors in, and here it'll be about whatever that contract was. So explain what a limitation of scope is. Here you say that they were unable because the employee left, so you're nearly just saying again what the scenario is saying. There are potential errors, and worst case scenario is that inventory should be reduced by the whole amount. Then we mentioned those different or alternate or different audit procedures. Could they get an expert opinion in? And if it's not possible, there's a limitation of scope. So you're just covering yourself to show that you know, like it's the examiner, you need to show the examiner you know. So you don't just jump, you don't just say limitation of scope, it's material. You have to explain limitation of scope, you have to show why it's material. You can't just say it's material, you have to work out the percentage here. Show that you know it's material because it's greater than 5% and it's not pervasive. That's just shows that you know, instead of someone that writes down a couple of words. I'll just show you what somebody might write in a minute. So we have material limitation of scope, so modified opinion, qualified one, and then write down the opinion. So issues with inventory about which we were unable to form an opinion. And then the basis of opinion paragraph will give more information. You don't need to write the basis of opinion paragraph, but it's good to show that you know that that's where all the information or most information will go, the further information to explain about the limitation of scope. Sometimes people only write the smallest of things, so this could be like an answer that someone would write down. Limitation of scope, material. They'll have looked at it and said, oh yeah, it is a limitation of scope, so they just write that down. Then they write down it's material. They might have done the calculation, but they don't show it. And then auditors should issue a qualified report. You're going to get very little marks. You're going to get some marks, but if there was 5 marks, or you might get 1 mark, because it's not clear you know what a limitation of scope is. You could be guessing. You could be guessing that it's material. You have to show how you calculate, how you came up to that conclusion. You have to show what limitation of scope is, that you understand it. And then qualified report, you need to show that you know what that is, i.e. this, the qualified report. I always write report instead of opinion. But you need to show that you know what a qualified opinion is, and that's That's what you need to write down to show that you know. So short answers like that are not going to get marks. Like, it's right, but there's not enough there. Okay, we're on to B then, dogwood profit sharing bonus agreement. So take a read of that then. What is there an error? Is there a limitation of scope, or are the accounts correct? So there's an error here, failure to adjust for a post-balance sheet event, an adjusting post-balance sheet event. The error is material. We worked that out pretty easy. 75,000, profit's going to go down by 75,000. The profit is given to us as 1,250,000. So you're looking at 6%. So it's material, and so a material error is qualified except for, so a qualified opinion, and you say, in our opinion, the accounts are true and fair except for errors in failure to provide for bonus payment. And you want to explain what an adjusting post-balance sheet event is, explain why the bonus payment after year end is adjusting. So if you look here, the year end is December 14. This happened in February 15. So the total bonus payment was only determined after year end. So all of that comes into your answer. That's the key thing. And then you just explain all that. So once again, be clear at the beginning, error in the financial statements. Profits overstated by 75,000. Explain here next about the accounting rule, which is the subsequent or post-balance sheet event. So reflects conditions existing at year end. So determination of the bonus to be paid after the year end is an adjusting subsequent event as the conditions stroke contract existed at year end, but the bonus only crystallized after it. Once again, I didn't spell that right. Then look at materiality. We've done that at 6%, and it's not pervasive because it's not large enough to make it unreliable. So it's repeating again. A lot of this is repetition, but you're only going to have 3 or 4 scenarios in a question. So it's like we're seeing them repeat here because we're looking at a number of past questions. But in 1 year, you're only going to have maybe 1, or 2 of these. So it's good to write this down because it shows you know what pervasive is. It shows you know what material is. So material error, modified audit opinion, which means where the auditor can't say the accounts are true and fair. You have to say something else. So, and then the type of modification is qualification or qualified opinion. And just because we haven't done one or haven't seen one, that's that answer. If the bonus payment, now don't confuse people, but say for example, the bonus payment was 54,000, not 75,000. Everything will be the same. It will be an error, an adjusting post-balance sheet event. You'd explain it just the same as we did in the question or in the solution that we looked at. You'd look at materiality next and you'd say, okay, the bonus payment was 54,000. 54 over 1,250 is 4% profit before tax. So it's immaterial. And then you're going back to your an error in the financial statements. It's immaterial, unmodified opinion. In our opinion, the financial statements are true and true. That's all you say. And you wouldn't say emphasis of matter, or you wouldn't mention the error in the audit report because it's immaterial. And it's not something you draw attention to because it's not something that's disclosed in the notes, for example. It's not a material matter that's disclosed that you want to draw attention to. So all you say is that. And it's the same with limitation of scope. If you work out that it's immaterial for whatever reason, usually below 5% of PBT, it's unmodified audit opinion. I'll quickly do these two. I won't do the answer because these are unmodified and I want to look at modified. But here, read this, part C. So the chairman's or chairperson's statement is other information. It's not part of the financial statements. The auditor doesn't audit it, but the auditor is meant to read it, the other information, in the annual report to see if it's consistent. And if it is inconsistent, you highlight that in another matter paragraph on the audit report. So here the financial statements are correct. The problem is with the chairman's or chairperson's statement. So the financial statements are correct. So unmodified audit report. In our opinion, the accounts are true and fair. Full stop. And then you have another paragraph called other matters, and then you highlight that the chairperson's statement is inconsistent. And I've looked at that separately in a different screencast. Looking at part D then, take a read. So once again, is there an error? Is there a limitation of scope, or is there something else? So we've read this. So such investments could result in massive losses, but nothing to indicate they have. The financial statements are correct. In the future there might be financial losses, but that's not affecting this year's financial statements. There are internal control deficiencies there. And we've reported this before. No action has been taken. Okay. But financial statements are correct, so unmodified audit report. In our opinion, the accounts are true and fair. Then you're not going to add an emphasis of a matter paragraph because it's not, there's nothing to emphasize. There's nothing emphasized about this in the accounts. So a normal unmodified audit report is where there's an error or limitation of scope that's less than 5% of PBT is immaterial, so you just issue an unmodified audit report. But for these circumstances, you add a paragraph in, number 1 to 4. So 1, 2, 3 are fairly similar. You're just drawing the reader's attention to something which is disclosed or which is in the financial statements. Emphasis of matter and material uncertainty or overgoing concern are very similar. Other information is where something outside the financial statements, such as the chairperson's report or director's report, is inconsistent. Key audit matters is something, the most significant matters audited. And number 5 then is for the question we're doing, a separate report to managers' accounts are true and fair. So here, unmodified audit report, and then an internal control deficiency report to management. And that'll be confidential, and there'll be no mention of anything about this in the audit report unless it was a key audit matter. That maybe it was, but it doesn't say so here. But you could say perhaps this should have been a key audit matter, and then the auditor would discuss it and show how they responded to it. But that's how you approach these questions. It's very important to write out and explain as you go. Where people fall down is they write something very short like that instead of explaining why, what is the limitation of scope, why is this one, how they calculated materiality, why isn't it pervasive, and what is a qualified opinion. You have to show you know these things. The examiner can't assume you know what a qualified opinion is. You have to show the examiner that you know these things. So thanks for watching and good luck with your exams. Luke Fannin here, Athlone Institute of Technology, Business Faculty. Thanks.